If you're looking to pick up more investment properties, but you're hung up with qualifying for traditional financing, stay tuned because in this video, I'm going to share with you 4 reasons why a DSCR loan may be a better fit for you and also 4 things to watch out for. If you're new to this channel, welcome. My name is 𝐶𝐐𝐬𝐬 and I help individuals and investors like you buy and sell homes and also fund loans. So let's dive right into it. What is DSCR? What does it stand for? In short, it's debt service coverage ratio, which means that as a bank, we need to make sure your mortgage payment is covered by your rent. It is ultimately a cash flowing loan. We don't care if you have any employment history, if you're unemployed, because I'm about to quickly break down 4 of the reasons why it's a better fit. Because there's a lot of myths of, is it a good product or is it too good to be true? And a lot of the consultations that I sit down with clients, I'm really trying to debunk that because this is in fact one of the most popular products that we write here. And the best part is it's in-house where there's less fees. So number 1, why it is a better fit is because there's less documentation. There's no 1099s, tax returns that are needed. We are not looking at any pay stubs because again, you could be unemployed. You're an investor. So long that the property can show it is performing, we need to collect just your driver's license and the last 2 months bank statements. What are we looking for in those bank statements? That you have at least the 20% minimum down payment. Now, 20% may be the minimum, but there's times where we may need to put down 25% to ensure that you are meeting the ratio. Okay, so we'll get into that. Number 2 is the scalability. You can buy as many properties without any limitations or caps. On traditional loan programs like conventional FHA, the Fannie and Freddie Mac who actually buys these products back as a secondary market limits you. Ideally, we've heard it where you can have 10 at most, 9 of that being conventional, 1 being an FHA. There's been talks that they were going to cap that over the years, but I haven't heard anything been enforced. If that does come about, I'll definitely create a new video about it. But yeah, so ultimately you can have 20, 30 plus units without any limitation. Number 3 is how fast and streamlined. We've closed these as quickly as 7 days, and in-house also gives us that advantage because we are processing it and underwriting it without having to outsource it. And number 4 would be the type of properties that you can finance. This is applicable to your single family, duplex, triplex, fourplex. Now, we can go up to more units than that, but that may fall into what we call a commercial DSCR, okay? So those are the 4 things I just wanna highlight. Now let's go into 4 things that you wanna watch out for. Number 1 is DSCR loans as a non-qualified mortgage has the reputation to have higher rates and fees. And this is where I'm gonna stop you because I just closed a loan last Friday and we were able to get the borrower at a 7.875 interest rate. Now, granted, in our current market, as of today, March 4th, let's just put it out there, 2025, that is our going standard rate. Whether you're taking out a conventional loan, things of that nature, we're gonna be hovering in the 6%, 7 percentile, depending on credit, down payment, type of program, etc. right? In the past, and having been in this industry for about 20 years now, I've seen the non-QM loans fluctuate anywhere from 1.5% to 2% higher typically than the current market rate. And in this scenario, I'm sharing with you that's not the case. But so let's go back to the few things to watch out for. As fees go, most banks tend to charge anywhere from 2.25% to 2.5% of the loan amount. So just for easy math, let's just say you're taking out a $300,000 loan at the 2.5%, right? That you're looking at $7,500 in fees. That's before down payment, closing costs, title, appraisal, etc. That's pretty hefty. Now, why I take pride in this product and really want to introduce it to you because it is available in-house. So that $7,500 fee would not be carried over to you as the borrower if you qualify to the guidelines of the investor that we would select and choose from, okay? Now, number 2, what else to watch out for? You're gonna need more reserves. When we collect those bank statements that I shared with you, as mentioned, we're also looking at anywhere from 3 to 6 months in reserve. So that can depend on what other real estate that you currently own. If you have a primary, if you have other investment properties, we're gonna need to make sure that not only can you cover this note in the event of any default of the market, of your tenants, that you can also cover, your other outstanding debt as well, right? So even though we're not looking at any debt income ratio per se, that is what we want to make sure that you have. So this product is definitely geared and designed for those that are equity rich, that has a lot of cash, mattress money, but aren't necessarily filing taxes in the light of full net worth. Are you with me? So just to kind of, keep that all in mind. Other things too is the minimum debt ratio. That would be number 3 to watch out for. Most banks require a 1 ratio. So let's just say, for example, your rent is $3,000 a month, right? And you're collecting $2,500. Well, that automatically will tell me that, all right, it's too low. This is, and by that I mean that you have to make sure your mortgage is covered by your rent. So ideally, what banks do is we take 75% of your market rent. So let's just say in a better case scenario, your rent is $3,500, okay? 75% of that would be $2,625. If your mortgage payment is $3,000, we would then recommend, hey, shop for a lower homeowner's insurance, premium. Maybe find a home that would then not have too high of an HOA. Because remember, we're taking the full PITI HOA payment, what I would call as PISHA, principal, interest, taxes, insurance, HOA, or any like SIDS and LIDs. Now, most markets can vary based on whether your property is performing, right? So a lot of people are saying, well, what if my rent doesn't get covered? What ends up happening is your interest rate may just get impacted. We may need a higher down payment. This is where I was referring to earlier. Instead of putting 20% down, maybe that 25% down, even 30% would then not only lower your interest rate, give you a more favorable interest rate, but then it will lower your monthly payments to then make our ratios work. Also, just to keep in mind, not every investor requires a 1 ratio. We can go lower. I've seen it go below 0.75. And again, every scenario is different, every market is different. I encourage you to go ahead and apply, and let's plug in the numbers and see how that all pans out, okay? Now, lastly is making sure that the appraisal, of course, appraises. One thing that I want to kind of also add on, that's obvious. We want to make sure the market rent jives and also the value supports the loan amount. But I've had people come to me and ask, Candy, I'm an investor. I'm looking to take out hard money loans to buy distressed properties. We want to renovate it and then, call it the fix and flips. So would a DSCR loan be an ideal product to acquire these homes because the interest rates are lower, the fees are lower, you're offering this in-house? And my answer to you would be this. That would not be a fit in this case to take a DSCR loan out to buy a distressed property. Why? Because you're typically, as an investor, would only be holding that property anywhere from 3 to call it 6 months. Okay, these products, the investors wants to know that you're going to at least hold on to it for a year. And if you're going to go the route where you're paying it off sooner, then we would go the no ratio route where there's no prepayment penalty, but you got to be prepared to put anywhere from 30 to 35% down. Okay, so in the event that you're willing to put that much skin in the game, then maybe the no ratio product going investment purchase is a route for you. So those are the 4 things that are advantageous, 4 things to look out for. And really what I want to share with you is this is very popular because it's just one of those that maybe you got an inheritance. Maybe you're doing a 1031 exchange and you don't want to fool around with all of the documentation. This has just been a very streamlined product that, one, it's very easy to qualify for. Most interest rates, most minimum down payments are 20 to 25%. The minimum credit score, you're looking anywhere from 680 and above would be ideal. And there's exceptions to lower, but those would be your most qualified candidates. So if you feel that this is something that you want to consider, A lot of people from California have been selling property. They're picking up property here in Las Vegas. I'll be happy to guide you in the Las Vegas and Denver markets, having lived there and also investing there myself. So if you found this information useful, please like and share this video, and then also hit that subscribe button, and I'll see you guys in the next video.